Deflation's nearly here. You mark my words, mark my words. Oh, I get this. Oh, mark my words. And everyone thinks that's a good thing. It's not. It's not. But we'll go into this. And the reason is why is simple. The Federal Reserve Board did not create inflation. They can't fix it because they didn't create it. They didn't cause it. They can't fix it. What caused inflation was high energy prices. That's what caused inflation. What is happening now is the opposite of high energy prices, which is pretty amazing to me. And we're going to go into this a little bit here. And I'm actually a little bit caught off guard. I didn't realize the level of, I didn't realize where we are. I mean, I've been thinking, it's like, what if the negative naysayers, me in particularly, in Europe doesn't freeze to death like we all thought was going to happen? What if we were wrong? What does that do? Well, inherently it's deflationary. Remember, inflation is always and everywhere an energy issue. An energy phenomenon. I need to trademark that. So Milton Friedman taught us that inflation is always and everywhere a monetary phenomenon. No, inflation is always and everywhere an energy phenomenon. And high energy cost, high inflation. Low energy cost, low inflation. It's just that simple. In the 70s, just the proof of that. Volcker didn't whip inflation now. Is a lower energy cost. This is just no two ways around this. High energy costs, high inflation. So let's dive into this article by my man George Calhoun. Chuck Calhoun, I thought I was going to call him Charles Calhoun. I don't know who that is. Inflation narrative falters, and now we'll have deflations here soon. I just want to go down to something here. And you can read the article. It's a great article. Percentage filled of natural gas reserves, October 28th, 2022. Poland, 98% of natural gas is full. Denmark, 100%. France, Germany, all within 90%. Isn't that crazy? EU average 94.1. That wasn't what we were expecting. Look at all these LNG tankers in European waters. More gas is on the way. Liquefied natural gas tankers are swarming Europe, all coming from here. We're subsidizing, which ticks me off. But companies that sell natural gas driven by the high prices flooded the European market. Special ships with huge amounts of LNG raced to Europe from the U.S., Qatar, and other countries, which of course has crushed prices. The flush storage facilities, they have a lot of natural gas in there, have caused short-term spot prices to plummet. Look at this, man. Here we are in February. Here we are back in October. Europeans' natural gas benchmark fell to 93 euros per megawatt hour, a drop of more than 75% from its peak when we're all thinking that Germany's going to freeze. European prices are still elevated above the pre-Ukraine norm, but the price is down 75%. The European gas market has seen this sort of bizarre glitch that hit the American crude market in April 2020. At one point, the hourly Dutch price slipped into the negative, meaning that with so little space to store purchase gas, traders were briefly willing to pay someone to take gas off their hands, to give it away. The same happened here. The price of the U.S. natural gas in the state of Texas fell to negative territory this week. It's weird we're not hearing this, huh? European forecasts are mixed. Recent headlines divide between those who scream, Europe faces unprecedented risk of natural gas shortage, and those who express bewilderment. Europe has so much natural gas that price dipped below zero. A few months ago, the media was full of dire predictions about the supposed shortage. I was too. Germany's rushing to build 5 floating liquefied natural gas terminals by the end of the year. Work has already started while permit applications are still being scrutinized. Anyway, it's crazy. Bigger picture, the natural gas market is beginning to worry more about gluts than shortages. The crowd of LNG tankers is leaning hard on the psychology of the energy market, and that G word is popping in the headlines as another gas glut on the horizon, says Wall Street Journal. European gas glut to help ease winter LNG crunch. Longer term, a huge structural increase in natural gas production is beginning to show. Gas producers are beginning to respond to the opportunity. The current buildup of liquefied natural gas ships waiting in Europe waters to offload their cargo has started to push prices down, hinting how quickly the market can shift. This is likely an understatement. U.S. shale gas production grew 73% from 2015 to 2020. It is projected to grow by another 30% in this decade, and there are indications the investment is picking up, especially as the attorney generals of the Republican states start suing the ESG clouds. I can't wait. Shale gas from fracking is a significant underdeveloped source of future supply in many countries as well. In short, the market is working. Here's commodities in general beyond natural gas. Look at all these things. Down, down, down. Lumber, aluminum, iron, natural gas, cotton, wheat, coal, crude, transportation. The backup of container ships off the Southern California coast as a heart of the supply chain congestion has effectively disappeared. And of course, this means that international shipping costs have plummeted. By September 2021, the average cost to ship a container from Asia to the U.S. was $20,000. Now it's $27.20, 84% decline. Freight prices declining. Zoops, 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 zoops. Manufacturing, producer prices have peaked. Right here, zoops. Here we are now, the forecast. Now, will it come to fruition? I would expect it will. Producer prices at peak and forecast to decline rapidly in the next several quarters. Retail. U.S. retailers have been sitting on a record $732 billion of inventory. Retail inventory surge. Now, retail is be interesting. I'm not quite sure I buy that. That's right for the short term, but we'll see. Department stores Kohl's has 48% more inventory than it did a year ago. Target has, let's see here. September after retail giants that have to aggressively mark down its excess surplus. Not even the country's largest retailer has been immune from inventory woes. An Amazon warehouse near Nashville has been overwhelmed by excess inventory. Automakers, the same thing. As day follow nights, these gluts will drive prices lower. Firms are discounting aggressively to reduce inventories. There are already signs that prices are easing in some parts of the economy, from appliances to bedroom furniture and everything. Retail prices for general merchandise averaged 1.2% a month increase, but since then, from September through March, but since then have averaged just 2 basis points, essentially flat. E-commerce, price index, oops, look at that. Even the insane used car bubble, oops. The inflation bubble burst. This is what the end of inflationary bubble looks like. Deflationary trends are working their way through the supply chain. Commodity prices are falling. Transportation costs are down. The PPI is dropping. Retail inventories are expanding, indicating the trend should shortly reach the consumer. When will the CPI show this trend? Will already be too late, 100%. Anyway, because they've already raised too much. Anyway, if not buying bonds now, I'm telling you, man, the days of the Fed raising significantly are over. They might do it two more times just to show that they're not afraid, but man, you can easily see, because when deflation happens, what happens? That's not good for the growing economy. Deflation is not what we need to do. We need a growing economy. Deflation is not a growing economy. So then they're losing again, just because they think they can control inflation and deflation. They can't. But when the deflationary numbers come, especially when they're starting to see some unemployment, I know we had a good jobs market today, but I'm telling you, man, if we get unemployment coming out of the pike because of the huge increase in loans, the cost of debt, that could be deflationary, 100%. But it's even more than that. It's because we have cheaper natural gas, cheaper oil, cheaper electricity, cheaper energy as a whole, cheaper cost to transport stuff. And when that starts kicking in, that could lead to growth, except for the fact that we have these higher interest rates. It's interesting, isn't it? We don't know. No one knows. But the Fed can't control it. But what's going to happen is when the growth starts to wind down, they're going to say, oh, we got to loosen again. So those people who bought those bonds before are going to be loving life, because during deflation, bonds kick ass and take names. Now, I don't think it's going to affect the consumer market for food anytime soon. I think there's going to be, over the winter, we're still going to see a pretty significant increase in prices on food. Just because of the inputs from May, the fertilizer inputs that was getting killed during the fall, during the spring and the summer for growing food and whatnot. But I think those are going to subside and start going down too, starting the beginning probably of towards the end of the winter time. Everything else looks like it's going to start coming down right away. And we'll see. I could be wrong, but I don't think so. I think deflation is coming. Now, that doesn't mean it's going to be a world war or a Great Depression. It just means it'll be more normalcy in terms of inflation, to the point where the prices go down. And when the prices go down, it's going to be a whole different ballgame that we're just not accustomed to. Yeah, love your thoughts. We'll see ya.